Karan Taurani is now joining us, Senior Vice President, Research Analyst at Elara Capital. Karan, good morning. Good to have you here. Prashant this side. Again, we heard from the management themselves in terms of the reason behind fundraising. But again, it is still exactly what this is going to be used for. Is this, as someone put it, posturing? Is this a little opportunistic? Or this is to do with having regulatory options in terms of how they operate in the marketplace? What's your sense, Karan?
Hi, Prashant. Good morning. So I think the fundraise, it's very clear now that it is not for any kind of acquisition. I think this is largely in line with our view. 2-3 reasons here. I think the fundraise, the first part is, to kind of take advantage, of the situation with Swiggy IPO being around the corner. There is a lot of interest, for these high growth companies. And, if the times are favorable, they would go for this kind of a fundraise and make the most of this opportunity. The second part is, in terms of the potential war chest, right? So we have quick commerce is now becoming a very big segment. It will scale up beyond the metro cities also potentially. And we don't know in terms of what verticals will click, how much of investment will be needed in this segment. So very clearly, they want to have a cash balance which is ahead of market, ahead of competitors, because they are the market leader in this space. And the third respite is that they very clearly mentioned that they will not use this cash to, discount and, make sure that growth rate, they want to focus on user experience and not just purely in terms of discount. So these three things are like some sort of a respite in terms of the, the fundraise that they're trying to do. And I don't see any potential negative impact, because of this so far.
Okay. Got that. Karan, morning. Good to have you on. Let's also talk about the second quarter numbers, and they're just looking better quarter on quarter, right? The improvement continues on the profitability side, on the GOV numbers. And I was looking at the details that Mangalam had shared. On quick commerce, I think the growth is well over 100%. So how do you map the trajectory from here on, given the stock price level? Because the stock has also rallied. So just run us through the growth and valuation dynamic here for Zomato.
So I'll come to the food business first. I think the growth rates there have been largely in line. Of course, it's moderated since the last 3-4 quarters. We've seen growth rates of beyond 25%. So that's kind of moderated. But I think that's part and process. I think we don't expect more than 20-23% growth in GOV in the food segment on a steady state. Margins again are largely steady on a Q1Q basis, but they are improving since the last 8 quarters, since we reached break-even point. Today they're at 3.5% as a percentage of GOV. So clearly traction in the food segment continues to be there. I don't think there's an issue in terms of food business or them kind of potentially losing market share for now. So, and in terms of valuations as well, we do see that this business can trade at about 80 times P and about 55 times EV/EBITDA basis execution. So two things to watch here would be the consistent growth rate of 20% plus GOV in food going ahead, and also the improvement in terms of margins towards that 4 to 5% band that the management has guided for. On the quick commerce side, it's very clear that they want to really gain market share here, and that's why the aggression in terms of adding more stores versus the peers, and they are on track for that as well. So growth rate in quick commerce remains to be good. Take rates are largely stable. That's primarily because of store expansion. Two good things in the quick commerce is that one, of course, the losses haven't increased, despite this heavy store addition that they've done over the last 2 quarters. So that is some respite. Second good news is that the new stores that they're adding, they are somewhere closer to 70% of their portfolio in terms of average throughput per day. So clearly the new store addition is, kind of generating good order volume, good traction, and this is not coming at the cost of, losses going up. The break-even point is maintained. So I think it's good news for both the food and the quick commerce business. Execution remains to be on track.
Okay, all right. Hi, Karan. Good morning. Good to see you in. Karan, the valuations between Zomato in the listed market and, there's a lot of action in the unlisted market. So how does it weigh between the two right now, Swiggy versus Zomato?
So I think Swiggy valuations, as per some media reports, are pegged at about $11.5 to $12.5 billion. We don't have it under coverage, so we'll refrain to comment on that front. But I think given the kind of the metrics that Zomato operates versus Swiggy, given the kind of market share numbers, given the kind of a higher AOV, higher customer base, higher scale, better profitability, better track record, better execution, I think I would still prefer a Zomato versus Swiggy for now, because clearly I think in terms of track record, they've been far superior. And whatever challenges we've seen so far is all external led. This Karnataka government kind of raising some kind of 2 to 3% higher outgo for gig workers. some kind of regulatory impact because of this Consumer Good Association going to CCI. These are all external measures, and they will have a negative impact on the company in some or the other manner in terms of the earnings. But internal execution remains to be on track and remains to be strong. So we'll still go with a Zomato over a Swiggy for now.
What are the current market share numbers? What are your channel checks indicating? How much is the gap between the two? And also, what would be your comfort valuation range for Zomato? I mean, how much more would you give it?
So I think in terms of the market share numbers on the food side, Zomato is about 20-25% higher market share versus Swiggy. They're at about 50% plus kind of market share on the food side. On the quick commerce side as well, if you look at Zomato's market share, they're at about 30-35% higher market share versus Swiggy as well, despite them entering this segment much later, after Swiggy. So clearly that edge remains. And I think in terms of valuations, we are almost near to the bottom now. And I think at price levels of 240 levels, these kind of markets where everything is falling, Zomato will be the very good price to accumulate, because 6 to 8 months down the line, once you roll over, our target price of 320 can potentially become over 400. So clearly, it's a good time to accumulate this stock, at these levels.
Okay. All right, Karan, we'll leave it on that note for this morning. Thanks very much for joining in and giving us some perspective over there.